G'day, Corey.
Benjamin.
We're back.
Yes, we are.
We the hoodie's on. He's getting serious,
We are.
mate. We got a big conversation to have today. Because we're revisiting an old client. So we talked probably 2 months ago. We introduced a girl named Jess who was on a casual wage, 50K or something like that, and she was looking to do an investment purchase. And it turns out she could do it. I think for a few people, they were quite surprised. And
Yes.
some of the feedback on social media was a little bit like, oh, whatever. But this is actually real. We're using the real uh, engines of our game to tell people, to show people how accessible this is. Now, we want to revisit her because in our story, Jess has decided she's going to go and purchase a new property,
Yes.
a new investment. And so for Jess, what we've done, I'll just quickly take people through the scenario, what we've given her. Um, so over here, here's Jess, and we've given her a little pay rise. She's gone and got a new job. She kept her casual job on the weekend, so she's bumped her income about 30K a year, because we're saying this is a couple of years down the track, and Jess is a focused, hardworking individual. And then she's decided you've got her 007 Investor Lane, her first purchase there, still chugging along. She hasn't put the rent up or anything like that, so we're not doing anything out of the ordinary. But she's looking now to buy a little $330,000 home, with a total loan amount of 300,000. So she can do it. Over here, you'll see we've got a lot of banks here that are offering her up to nearly $500,000 in loan, and so she can do it. And this really shows the ease of investing, doesn't it, Corey? Um,
Yes. Yeah, that's right. If you're buying the right type of property at the right price point, it's far more achievable to build wealth rather than buy
yeah,
and equity just to.
yeah. And we work with buyers agents, don't we, Corey? And so for people out there going, you can't find a house for $330,000, you get the right person for working for you, and yes, you can, right?
We've got I think I mentioned it last week in our video. I think the lowest purchase price I've seen is 290. I think it's just
And that's in the last month.
I think 2 weeks ago.
Yeah,
There 2 or 3 weeks ago. I think it's 1,000 square meter property. Needs a bit of elbow grease. And there'll be some equity in it. Now, I also want to point out that investor loan, I believe that's the purchase price from 2 years ago. Likely that's sitting at the 400, 450 range today
yeah.
as well.
In
But
terms of value.
the right buyers agents are out there um, that can find these properties and have these relationships with off market opportunities.
Yeah, and that's the value of a buyer's agent. Is a good buyer's agent is going to save you about 30 or 40K going into the property, which is all equity. You're buying at 30, $40,000 below what it's worth. You've already got 30, 40 thousand
Correct.
dollars.
Look, but there is a fee for a buyer's agent. That's how they make their money, right? They don't get commissions. They charge a fee based on the type of deal they're getting. You're still better off.
Yeah, yeah, absolutely. So we got Jess here, mate. Someone on 70K just running a 10K weekend job. Um, that's not a lot of money. We're not talking someone who's gone
No.
to uni and gone and done, their massive course. This is someone who's just working hard, who's very diligent, right?
Correct. And there's plenty of them out there.
Yeah,
We're dealing with these type of clients all the time,
yeah.
and a lot of young men and women who single, not earning big incomes, and we're seeing them we're seeing them build up a portfolio.
Yeah. Yeah. How many conversations a week would you have with someone like Jess?
Uh, Look, we have various clients, but it's 2 or 3 times we've got a single applicant
Yeah.
who is in their 20s
Yeah.
that 2 properties already.
Making this happen. Yeah.
Yeah.
So if you're out there and you're in Jess's shoes, please call us because we can link you with the right people who can get you on the right journey. we can have the conversation to help you get started on this journey. But the key thing I want to highlight today is at this point, it's key for a strategy. It's key about the structure that we actually move forward with from this point. You have, the moment you go beyond 2 properties, it's a very, very, very different scenario, right? And so, want to talk through a couple of products and some things that I guess are relevant here. So, firstly, it's important that brokers actually understand this, and this is our strength, I guess, in a lot of ways. Corey, is actually understanding how structure and strategy works for investments. Do you want to just talk about the value of structure and strategy?
Absolutely. I want to highlight there are a lot of great mortgage brokers out there. Every single one has their different skill sets. Our skill set now, our bread and butter is investors. I've been exposed to this with various different referrers and learnt a lot along the way with the right professionals around, like accountants and lawyers and the like. Not every broker gets this
No.
completely. They get the product side of things, but for a lot of brokers, you get to a point where you limit your portfolio, where you're waiting several years before you can continue to build it. However, there are a lot of brokers out there like us as well who understand this structure, and there's plenty out there.
Yeah.
The importance of lending strategy is and structuring and how you do it makes a difference between buying a third property or waiting 7 years to buy a third property.
Yeah. Yeah.
It's important in terms of how what next steps you take is how you make a third step.
Yeah.
For example, are we doing a lower deposit because you're going to have more deposit for a third purchase? Are we doing a higher deposit because it's borrowing capacity, and the lower deposit makes it more difficult? It's incredibly important to have the right conversation, and also obviously lots change, but to understand, well, if I do this, what's likely to be able to happen next?
Yeah. Yeah. Absolutely. So having a look at this deal, you've got here interest only term.
Yes.
Do you want to just talk through pros and cons of interest only?
Yeah, look, obviously I'm not a tax agent, but a lot of our investors go interest only for a few reasons, Ben. One is to maximize cash flow. Okay, so that means you're not repaying the loan, you're building up your bank account more so.
Yeah.
Or if you're someone who has an owner occupier and has an investment, you're likely paying what principal you would pay to your investment to your primary mortgage instead. A lot of clients do it for tax purposes, right? The interest is claimable, right? So if you're paying down an investment loan, you're losing deductibility over the time of the loan. You can't gain that back from what you've paid down. Obviously, tax advice is needed there. So that's one thing, right? The benefit to principal and interest, even though I probably don't recommend it for investors, the benefit to principal and interest is one, you're reducing your debt, so you're reducing your risk. And number two, you're also increasing your borrowing capacity. The banks actually assess investment interest only lower than investment principal and interest. And the reason for that is because they actually assess the deal instead of being 30 years, they assess the deal can you pay it off in 25 years.
Yeah.
So you're
Wow.
actually gaining an extra 5 years of borrowing capacity on how they assess it. But obviously, even though we're probably the big fans of interest only, there does need to be a time bend where there's, a payment plan or a plan to reduce debt. You can't hold debt forever. You need to get to a point where, well, how are we going to start dominoing these debts? But initially, interest only is the way because of the cash flow purpose. And that's probably a big highlight. But again, what's the opportunity cost? If you don't have any serviceability on interest only, are you still better off buying a property or not buying a property? And if it means principal and interest, I'd probably say it's still worthwhile.
Yeah. And look, a couple of things you mentioned there, but you talked about what this does to a deal. We've got 5 years interest only here. If we were just to put that to zero, you'll see a couple of things change here. One, the max capacity of the loan increases, and two, the interest rates on offer decrease. So we're still at 90% here. We'll talk about that in a second, but it's still, you're going to get a lower interest rate and you're going to get more borrowing capacity, but you've got a higher repayment
Correct, because we're
per
paying.
month. So that's the trade-off there. But if you're struggling to get the loan that you want, sometimes you need to go without the interest only to get the borrowing capacity that you need.
Or it could be a lower interest only term. It might not be 5 years, might be 1 year. And you have to read.
Put that to 2.
Yeah.
Yeah. It's still there.
Yeah.
And that I guess takes us to the next one of, well, let's look at 80 versus 90% LVR. You've got here 80 versus 90%. How about you talk through the pros and cons of this going forward?
Yeah, look, I think again, one's an opportunity cost and one's an affordability, right? No decision is right or wrong. Okay, most investors will push the 90% piece because one, they're injecting less cash upfront into the deal. For example, if you got 200K, it means you're going to have money left over to buy a couple more properties at 90%, right? So that's an advantage there. You're able to progress your portfolio faster, going at 90%. The trade-off there is obviously you're paying the lender's mortgage insurance, which gets added to the loan within 90%. You're essentially paying the bank's insurance to take a risk on you. The bank's looking at a higher risk because you're paying a lower deposit. So you're paying their insurance within the loan.
Which is generally around what, $3,000 to $5,000?
Every lender and insurer, but it's around 3% of the loan amount of the base amount, is what you get charged. Borrowing capacity decreases because the interest rate is higher. Okay, because they're penalising you for having a lower deposit. Okay, benefits to 80%. Again,
I'll just change this to 80%, so you can see
see
shift in this.
Right, you'll see the rates decrease. You can see down the bottom we've got some 6s there. We were starting in the 7s before. So the benefits are, one, you're gaining equity from the start, right? You're gaining, so if the property values go up, you've got equity straight away. That's available working equity.
And later on down the track, you can borrow to 90%.
You can. Yeah. You can. And it's a lower LMI point. But in terms of if you are to refinance a loan, you're going to have less trouble, right? At 80%, your cost is going to be lower, your borrowing capacity is going to be lower. But the disadvantage, again, is you're having to put more money in up front. So what that means is you're not progressing your portfolio as fast. So you have 90% is an opportunity cost, 80% sensible. Neither is the right or wrong decision. It's really what your goals are.
Yeah. Now, we've got as well the reality of you're talking a lot about heading forward, and these kinds of things. And so a lot of what you think about is not about this purchase, you're thinking about the next one. So that's what we're really trying to nail down here. Now, a couple of other products. You talked very briefly about LMI. Now, there's been a lot of people talking recently about 88% deposits.
Yes.
What do they mean really when they're saying, I want to pay an 88% deposit, 88% LVR, 12% deposit? What are they really talking about there in terms of that being the sweet spot?
The reason they're talking about that is, one, it's essentially an 87 or 88% base loan. Okay. The reason they do that is essentially you're paying your lender's mortgage up front because the banks are going to capitalize lender's mortgage insurance, which means you're going to have an LVR of 90%. Very, very few lenders allow us to go above 90% for an investment type purchase. So the reason that a lot of these people talk about that being the sweet spot is because you're getting in at 90%. You're a client that has $150,000 and you're buying a property that's $400,000. You're putting in significantly less cash. You're putting in half the amount of cash. It means you have half amount to buy another one. That's why it's being the sweet spot. And again, it comes down to what your goals are. You might only want one investment property or two investment properties, so 80% might be the goal for you. But if you're someone that's wanting to build a portfolio of 5 or 6 properties within a few years, 90% is probably the approach, or 88%, because you're putting in less cash up front and you're saving your cash for other purchases.
Yeah. Yeah. So heading forward, then we've got variable versus fixed. How about you talk us through that in terms of investment? We're just talking investment here, so we're not talking about variable versus fixed in a wide thing. But what's really the key thing here to talk through with variable versus fixed?
Look, historically, the bank has won fixing your mortgage. Um, Probably up until 2 years ago, where the rates were down in the ones and the early twos. Um, Look, fixed versus variable. I think variable is usually the sensible approach to go with investment, and the reason for that is because you have a little bit more control. Meaning you may need to refinance for a cash out, or you may need to cash out, which means you can extend the loan term, which increases borrowing capacity. If you have it fixed and you need to get a cash out, you're having to do the servicing based on how long the term is already. Otherwise, you're up for potentially a rate lock being broken, which means fees to break a fixed rate. And variable just offers more control. Now, in a market where the interest rates have been going up, that's probably um, frustrating to hear. However, historically, the bank has won fixing your loan. And from what we can see, having Macquarie Bank, for example, reducing their fixed rates, it's probably demonstrable that we're going to start to see interest rates decrease. So variable gives you a bit more control. It doesn't give you as much certainty around rates, obviously, but fixed isn't a bad option. If you plan on buying nothing for 2 or 3 years and you're someone who just wants to know what their budget is, well, fixed will help you with that. Fixed will make
Yeah.
you plan and be able to budget. But if you're looking to grow your portfolio quickly and aggressively, variable provides more control of the destiny and the outcome of that portfolio.
Yeah. Yeah. And the key thing of all of this is you got to find what is going to be the right structure for you. So having the right broker in your corner is key because I mean, even on the 80 versus 90% conversation piece, like on a $500,000 loan, it's about a $35,000 initial upfront investment difference.
Yep.
So if you're going, I want to do multiple properties, you've got to come up with, if you want to do 80%, it's 70 grand for two properties. It's, heading over $100,000 if you more if you want to do it over three. So this is why you need a good broker in your corner. And next week we actually want to chat about the value of a broker and how this actually works for people who are out there going, like, why would I go through a broker as opposed to just going online searching because I can get the information myself, right? Why would I go to a broker and what's the value of a good broker heading forward? So we'll talk about that in next week, so stay tuned. But at the end of the day for Jess, the headlines are, can I buy another property? Yeah, absolutely she can. And with growing equity in her property and all these kinds of things that are happening, there's a great opportunity in front of her. Um, um, the reality though is she has to be thinking through structure point of views and structured conversations heading forward. And so, I guess as we finish, final question, Corey. If someone's out there and they're looking to go on this journey, how about you just share real quickly? I know we're going to cover this a fair bit next week, but what's the value of a good broker and a good structure?
Look, I would say again, I'll repeat this because I don't want to badmouth my anybody in my industry. We have a lot of great brokers in this industry. Benny, I'm going to say 90% of our business that comes in is us having to have a strategy for clients that have had a broker before, have gone to the banks directly, that didn't understand investments and building portfolios, right? They don't understand the intricacies of structuring lender policies that can help you continue to borrow.
Yeah.
We actually have a lot of that where we're actually finding those solutions or giving
Yeah.
them how to move forward to then restructure. So that's one thing. But it is highly important to be getting the right broker in your corner that one is willing to believe in you and what you're wanting to do, and two, be able to facilitate and give good advice around how the next steps are. And that isn't always a nice warm cuddle from us. Sometimes it's a real conversation on, you've got too much debt here in your name. You've got this car repayment that's $800 a month. that's $180,000 in borrowing capacity gone. You're spending $9,000 a month on rent and a good living, good life, which everybody wants. But sometimes it isn't always a nice conversation. Sometimes it's a confronting conversation, and that's going to help you decide whether you're really up for this or not. Because we have some clients that have really high incomes, couples that only have one investment property but nearly no borrowing capacity because of how their lifestyle's set, right? So it's important to have the right team in your corner. Obviously, we have the accounting team that help with some of this stuff as well, which we'll introduce next week and over the coming weeks in some further calls. So it's important to get the right people in your corner that understand investors, that have probably done investing themselves as well. That's another thing, and have a good track record.
Yeah. Yeah, it's awesome, mate. Well, Corey, that's a fantastic lot of information. And for people out there, as we always say, if you're looking to do this journey, we'd love to help. We'd love to serve you. We'd love to go along in that journey and have a relationship of ongoing helping you, making this a really great journey of investing for you. So with that said, that's it from us. Stay tuned next week. We are talking about brokers and the value of them, especially talking into investor world. And then heading forward, we've got part 2 of James coming up. James is getting married, so it's dual incomes, a whole thing going forward. We've got all of our scenarios are going to be growing and developing. We're going to be showing the intricacies of these ongoing and how you can save money, because ultimately we want to help you out there in the internet space to do well. So, mate, thank you so much, Corey.
I want to point out, Ben, before we end this, I want to point out this is a tool that we have that we use up front. Broking isn't as easy as plugging in a couple of numbers and finding. I just want to point that out. Like, we use this for an initial conversation with clients. Every single one of these banks you see here, we have to do individual pieces of work for, which means individual Excel spreadsheets, calculators, and also siphoning through large policies and documents, and making sure, because they change fairly regularly, these policies and all at different times, we're having to do research on every deal.
Yeah.
Please don't look at this and think, oh, broking's easy. Like, I can't anyone to do it. This is just a simple tool that we use as maybe
visual
aid for us to go, the client's in a great position, let's start progressing this and dive further, or the client's in a bad position, time to fix up some things. So I wanted to, before we ended the call, point that out, that this is not a tool that makes decisions. This is a tool that helps us have a quick conversation with the customer.
I remember you talking a few weeks ago, Corey, about how many individual tasks you have to complete to get a loan through. It was something ridiculous.
Yeah, it's over 300.
300 tasks.
That's amongst contacting the bank. You have to review some clients have 20 bank statements and multiple incomes and multiple investment properties. You're having to go through every single document and find stuff.
Yeah. Which brokers do for you, which is fantastic. All right, mate. Well, I'll let you get back to your day. And for anyone out there, if you want more information, just hit us up on the social media here, reply to this post, and we'd love to be able to help you in any way that we can. Have a great one. We'll see you next week.
Guys.